friends, welcome to CC Online Lectures. Myself, Dr. Aditya Tripathi, Assistant Professor, Department of Commerce, Shamlal College, Evening University of Delhi. The topic of my today's lecture is overhead variances. My dear student, this is going to be part 1 of this lecture on overhead variances. I'll be telling you how to calculate the overhead variance, the different types of overhead variances. But before going for understanding the different formulas which are being used into this computation of overhead variances, let me tell you what exactly is the perception among the students about overhead variances. When it comes to understanding and computing it, students are finding it very difficult to remember or recall the formula of this particular topic of standard costing. The only reason behind that is the lack of conceptual clarity. First of all, we need to understand what exactly is the overhead. My dear students, as I told you at the very outset, that there are three components of cost: material, labor and overheads. So this overhead is going to be the third component of our cost as far as cost accounting is concerned. And in relation to these three components of cost, the standard costing is also computing the variance for all three components of cost, starting from material variances to labor and then overhead variance. Since you have already understood how to calculate material and labor variances, it's quite easy for you to recall the different ways to compute this particular variance. The same is the process for overhead also, as we have been following for material and labor. But there are certain differences which are the fundamental difference, which you can call as a fundamental difference between among other two components and this particular component of our cost, that is called overhead. Now what is overhead? Overhead is basically a combination of indirect material, indirect labor and indirect expenses. So basically any expense which is not direct can actually be called as overhead. So as far as overhead is concerned, basically it is any cost of production which is not direct. When I'm saying not direct, it means I'm talking about indirect cost. Indirect cost means this cost cannot be attributed to a specific product, and that is the only reason why it becomes indirect cost, and that is why we are calling it overhead. Now the overhead can be of two types. One is the fixed overhead, the other can be variable overhead. When I'm saying fixed overhead, it means the amount is fixed in total. And when I'm saying that it is variable overhead, it means it is per unit fixed, which means it is varying with the change in production. If your production increases, your variable overhead is also going to increase. If your production decreases, your variable overhead is also going to decrease. So with this basic understanding of overhead, what the overhead is and what can be the possible classification of it, let's start understanding what is overhead variance. What exactly is the overhead variance? So first of all, what is overhead? As I told you, overhead is the aggregate of indirect materials, indirect labor and indirect expenses. The same which I told you at the very outset, that overhead is basically the combination or aggregation of indirect material, indirect labor and indirect overheads. Overhead variance is basically the difference between the standard overhead and actual overhead, which means the costing department must have set some or established some standard for your overheads also, and we have to compare it with the actual overhead to determine whether there is any variance or not. If there is some difference, that can be called as variance. It can also be adverse, favorable or neutral as the case is. If my actual overhead is greater than the standard, then obviously it is going to be adverse for us. If my actual overhead is exactly equal to the standard, then obviously it is neutral. Otherwise, if my actual overhead is less than this favorable standard overhead, we can call it as favorable. So the way of assigning tag of favorable, adverse or neutral remains the same regardless of the component of cost, whether we are talking about material variance, labor variance or overhead variance, right? So overhead, once we understand what is overhead and what is the overhead variance, it is quite easy for us to give a classification to it. But before that, let me tell you that broadly speaking, if somebody is asking me what is overhead variance, we can call it as, or we can say that it is basically regarded as under and over absorption of overheads. My dear students, when this term comes under and over absorption of overheads, I was going through different study material and books available for you, and a very basic and pertinent question was coming to my mind, that none of them are explaining what is under absorption and what is over absorption. Although they are giving an example to it, they are saying this is under absorption, this is over absorption. But a very pertinent question comes to you. What is absorption? What do we mean by the term absorption of overhead? If some overhead is there, where it is getting absorbed, and the same is explained into absorption costing also. That is why I thought it to be very relevant that before I explain you the concept or the formula of overhead variances and their computation, let's discuss what is over absorption and what is under absorption. When I say the term absorption, absorption means the cost which is attributed to a specific production, a specific product which is being produced, which means it is getting absorbed into this particular cost. When I'm saying absorption, which it means it is getting absorbed into that production process. That you need to remember, that absorption means the cost which is being absorbed by the production of that particular product for which we are doing the discussion. So let's try to understand what is under and over absorption with a small example. Here you have an example of different units of production. Suppose if I take an example that these three different productions given in the first column, they indicate about the three different monthly or yearly production by a particular unit for a given product, say 1000 units, 3000 units and 1500 units, right? Now the overhead absorbed at the rate of rupees 2 per unit. This is actually the absorption rate decided by the costing department. It means that as far as the production is concerned, this overhead is computed, the rate is decided. A particular rate is decided for the absorption of this overhead, and here for instance this rate is rupees 2 per unit. So regardless of the actual overhead, what should be the absorbed amount, the amount which can be absorbed to the production, or you can say which can be considered as cost of producing this particular these particular units, say 1000 units if I am producing, I would say I'll simply multiply it with the 2 rupees per unit of overheads and I'm getting an amount of rupees 2000. Now this is my absorbed amount, overhead which is absorbed. The same process I have to follow for others also. If it is 3000 units, I am multiplying it with 2 rupees, it becomes 6000 rupees. If it is 1500 units, I am multiplying it with the 2 rupees per unit, it is becoming 3000 rupees. Now this is the amount which we are already having in hand. If anybody is reporting me that this is a unit of production, I can very easily tell you that this will be your overhead which is going to be absorbed. So here the overhead for first case comes to be 2000 rupees. Actual overhead which is reported as 3000 rupees. Now we have to decide whether it is a case of under absorption or over absorption. So you have to be very cautious while understanding this. You need to listen to this particular explanation very carefully. What I am telling here is 2000 rupees is the absorbed amount, overhead absorbed at the rate of rupees 2 per unit for production of 1000 units, whereas actual overhead is 3000 rupees. Now there is a difference of 1000, which means that actual overhead is greater than the overhead absorbed. Now this 1000 rupees can be called as a case of under absorption, cause your overhead absorbed is 2000 rupees, so your absorption is less than your actual overhead. Understood? My absorption is 2000 rupees, which is less than actual overhead, so I will say it's a case of under absorption. The same we will compute in second case. 6000 rupees is my absorbed overhead, actual overhead is 3800. I would say it's a case of over absorption 2200, which means your absorption is greater than the actual cost. Then 1500 units, your absorption is 3000 rupees, your actual is 4200. So again it's a case of under absorption. Now this under absorption is being indicated by downside arrow, whereas the over absorption is indicated by the upside arrow. So I hope you must have understood what is under and over absorption. According to the direction of absorption, that is under or over, we are either going to inflate or deflate the cost of product as per the case. But here my point of submission to you is that we have to first understand what is absorption. since the rate is already predetermined, we don't know, we don't have any idea about the actual cost of actual amount of overhead in hand beforehand. But what happens, we are having some estimation, and on the basis of that we decide a rate, and this decision of having a specific rate of absorption becomes the basic reason for variance. Since the rate is decided well in advance and actual amount is computed, actual amount is coming at the time of actual production, so obviously there are chances of having differences, and that difference is nothing but your overhead variance. So I hope you have understood what is under and over absorption with this very small example. Now let's talk about overhead cost variance. I'm starting with the overhead cost variance. What is overhead cost variance? It is basically the difference between the standard overhead and actual overhead. Or you can say, here we are using a term called recovered or standard overheads and actual overheads. When I'm saying recovered, in certain books you'll find for this particular recovered term, you'll find a term called absorbed overheads. So either you call it absorbed, or you call it recovered, or you call it standard, it is the same. So overhead cost variance, while computing it, we have to first compute what is my standard overhead or recovered overheads, and I have to compare it with the actual overhead to arrive at variance. So formula becomes recovered or standard overheads minus actual overheads. Or you can say, if I have to explain this particular formula, I have to expand this formula. The formula becomes overhead cost variance is equal to, for standard overheads, the formula is standard hours for actual output into standard overhead absorption rate. That rate I'll tell you how to calculate, and then the resultant value is deducted from actual overhead to compute the overhead cost variance. So overhead cost variance is basically the difference between the standard overhead cost and actual overhead cost. This is what I wanted to explain at the very outset, that how to calculate overhead cost variance. The formula remains the same, the standard overhead cost minus actual overhead cost. Now, how to calculate standard overhead absorption rate? It is very simple to calculate it. The organization is going to provide you the budgeted overheads and a budgeted hour. If I'm talking about the labor. So that budgeted overhead is divided by budgeted hours. Because if it is given in terms of labor hours, then obviously the budgeted hours will be given. So we'll be computing it by this formula. Standard overhead absorption rate is equal to budgeted overheads divided by budgeted hours, right? Now the question comes, what are the challenges in computing overhead variance? The first very challenge while computing in standard costing, while computing the overhead variance, the first very challenge which comes to us is that the standard overhead rate for fixed overhead is difficult to establish. The reason is very simple. The fixed cost is given for a capacity. The fixed cost is always given for a given level of output, or you can say the capacity of the plant. So the moment the production of the plant is the capacity which you are going to use, it changes, your overhead absorption rate is going to change, and that actually makes our task very difficult. Because as far as the computation of fixed overhead absorption rate is concerned, it depends on the number of hours, or you can say the cost which we have computed. The cost which is given to us is always fixed in total. What is changing is the time and the number of unit produced, and this makes our task very difficult for computing this overhead variance. Also, there is a conflicting terminology, and there are different ways to compute overhead variance, which actually makes this task very difficult for especially the students to understand, because different books are having different sets of formula, and students are getting confused how to calculate which formula to rely and how to recall the formula. So that becomes very difficult. The same is the case of cost accountants also. Since there is no standard for it, there is no standard like accounting where we have some accounting standard in IND AS or IFRS for accounting. Unlike that, here in case of cost accounting, in standard costing, we don't have any such standard for devising a standard formula. And because of this only, it becomes very difficult for a student to recall the different formula, because there are different ways and different conflicting terminologies which are being used for this particular topic. But that is not going to be an issue for us when we are discussing here, because I'll tell you clearly what is the formula and how to calculate. Now the question comes, what is the subdivision of overhead variance? Basically, the overhead variance is the outcome of or function of two basic differences or variances. One is variable overhead cost variance and the second is fixed overhead cost variance. So when I'm saying there is overhead cost variance, there can be two possible reasons to it. One is the fixed cost variance, fixed overhead cost variance, and the second is variable overhead cost variance. So these are two possible reasons for overhead variance. So let's try to understand what is the way to calculate variable overhead cost variance. When I'm saying variable overhead cost variance, it is defined as the difference between the standard variable overheads and actual variable overheads. Always remember, my dear students, whenever we are computing the variance, it is always the difference between the standard and actual. So whether it is material variance or labor variance or overhead variance, the basic fundamental principle is the difference between the standard and actual. If I have to show it by formula, variable overhead cost variance is equal to standard hours into standard variable overhead rate. In this way we compute the standard variable overhead cost, and then we deduct actual overheads from it to arrive at variable overhead cost variances. So standard hours into standard variable overhead rate minus actual overhead. Now the question comes, what can be the possible reason for this variable overhead variance? So we have to now justify it. Variable overhead cost variance is the function of two variances. One is expenditure variance and the second is efficiency variance. So either it is due to expenditure variance or it is due to efficiency variance. So once we are computing variable overhead cost variance, the sum total of expenditure and efficiency variance must be equal to variable overhead cost variance, or in other way we can say we justify variable overhead cost variance by computing expenditure variance and efficiency variance, right? If I talk about variable overhead expenditure variance, it is also known as spending variance or budget variance. When I'm talking about spending, which means I'm talking about the expenditure. Since it is expenditure, so obviously it is going to be a spending variance between the budgeted value and the actual value, or you can say standard expenditure and the actual expenditure. It arises basically due to the difference between the standard variable overhead, which is allowed by the costing department, which is prescribed by the costing department, and the actual variable overhead, which is incurred by our workers or incurred by the costing department. So on one hand we have a standard, we have an allowed level of variable overhead, and on the other hand we have the actual variable overhead which is reported. The difference between these two is basically becoming the reason of variable overhead expenditure variance. Variable overhead expenditure variance, if I have to show it by formula, the formula is standard variable overheads for actual time minus actual variable overheads. So my dear students, mind here, when I'm computing variable overheads expenditure variance, the formula is standard variable overhead for actual time, the actual time for which it is being used, minus actual variable overheads. If I have to show it by formula, if I have to expand the formula becomes standard variable overhead rate into actual hours. We multiply it, and in this way we get the standard variable overhead for actual time, and after that whatever amount we get, we deduct from it actual variable overhead cost, which is reported by the costing department, right? Now comes variable overhead efficiency variance. That is the second part of variable overhead cost variance. Basically it arises due to the difference between the standard hours allowed for actual output and actual hours. So here comes the role of time, the standard hour which is allowed for actual output and the actual hour. If there is some difference between these two, then obviously we are going to have variable overhead efficiency variance. So my dear students, when we are talking about efficiency, it means we are talking about productivity, and that is why we have to recognize the role of the time, that is standard hours allowed for actual output and actual hours. As far as formula is concerned, variable overhead efficiency variance is equal to standard variable overhead for actual production minus standard variable overhead for actual time. Now here we find the difference between the standard variable overhead for actual production, and then we are taking the second part. In the second part also we are taking the same thing, that is the standard, but the difference is it is standard variable overhead for actual time. If I have to expand the formula becomes standard hours for actual output minus actual hours. Whatever the difference is, we multiply it with the standard variable overhead rate. to arrive at variable overhead efficiency variance. So the formula here is dealing with two standards. One is the standard variable overhead for actual time and the other is standard variable overhead for actual production. So the first part is dealing with the production, whereas the second part is dealing with the time. Now in this way you have understood that fixed overhead, how to calculate the variable overhead variance and how to justify it by computing the expenditure and efficiency variance. Once we have understood the variable overhead variance, it's time for us to discuss about fixed overhead variance. Now what is fixed overhead cost variance? It is basically again the difference between the standard fixed overhead cost for actual output and actual fixed overheads. The formula is very simple here. Fixed overhead cost variance is equal to the fixed overhead cost is equal to the standard fixed cost minus actual fixed cost. And if I have to expand the formula becomes standard hours for actual output into standard fixed overhead rate. Standard hours for actual output and standard fixed overhead rate, which will be computing, and then whatever we get, that becomes standard fixed cost, and afterwards we deduct actual fixed overhead from it to arrive at the variance, which is becoming fixed overhead cost variance. So the formula is standard hours for actual output into standard fixed overhead rate minus actual fixed overheads. Now the question comes, what are the possible reasons for this variance? What can be the possible reasons for this variance? See, there can be two possible dimensions to it. I'm starting with the first one. See, a higher or lower amount of overhead might have been incurred in relation to standard fixed cost for same production during the same period. So what is different here? You are spending either a higher or lower amount of overhead for the same production and for the same period. Time is constant, number of units produced is constant. What is changing here is the amount of overhead. So if my amount is changing, if I'm talking about change in amount, it can go either way. Either increase in the amount of expenditure or decrease in the amount of expenditure. So a higher or lower amount of overhead may be incurred in relation to standard fixed for same production during the same period. And if this is happening, what we call it technically, we call it as expenditure variance. Why do we call it expenditure variance? The only reason for this is cause the amount of expenditure on fixed overhead is changing, nothing else. Production is constant and my time is also constant. What is changing? The expenditure only. That is why we are calling it expenditure variance. The second possible reason can be the same amount of overhead is being spent. Now mind here, my dear student, here the amount is constant and it might have been the same amount might have been incurred for a higher or lower production in relation to standard production during the period. So here what is changing? The level of production, since the change is occurring because of volume, or you can say units of production. So that is why we call it as a volume variance. So what is volume variance and what is expenditure variance? I hope you must have understood. Now the subdivision of fixed overhead variance. Once we have computed fixed overhead variance, we have to justify. We have to justify it by computing the expenditure variance and volume variance. Again, I would say it is justified by the sum total of expenditure variance and volume variance. So whatever we compute by in fixed overhead cost variance, the sum total of expenditure and volume should be equal to fixed overhead cost variance, right? Now what is fixed overhead expenditure variance? It is also known as spending variance or budget variance, and it arises due to the difference between the budgeted fixed overheads and actual fixed overheads. What is the formula for it? Fixed overhead expenditure variance is equal to budgeted fixed overheads minus actual fixed overheads. The second is the volume variance. As I told you, it arises due to difference between the standard output and actual output. Since the volume is changing, that is why this variance is occurring, or this variance we are witnessing because of the change in volume of production. The formula is very simple: recovered fixed overheads minus budgeted fixed overheads. So whatever is budgeted fixed overhead, we find the difference between the recovered fixed overheads and budgeted fixed overheads to arrive at volume variance. If I have to expand the formula becomes standard hours for actual output minus budgeted hours. So we are finding the difference between standard hours and budgeted hours, and then the same is multiplied with the standard rate, and accordingly we are assigning the tag of favorable, adverse or neutral as the case is on the basis of the amount which we are receiving there. Now let us recapitulate what we have studied. So my dear students, I have simply tried to explain you what are the different components of overhead variance. So starting with the overhead cost variance, which is the function of fixed overhead cost variance and variable overhead cost variance. Fixed overhead cost variance, the formula is recovered fixed overheads minus actual fixed overheads. For overhead cost variance, the formula is recovered overheads minus actual overheads. And for variable overhead cost variance, the formula is standard variable overhead cost minus actual variable overhead cost. So this is basically the first formula, the first set of formula for overhead cost variance, which is a function of fixed and variable overheads. Now we have to further justify the variable overhead cost variance, which is a subdivision of variable overhead, where the subdivision is variable overhead expenditure variance and variable overhead efficiency variance. So you can say it is the sum, variable overhead cost variance is the sum total of overhead expenditure variance and efficiency variance. Now the same is the case of fixed overhead cost variance. Here also we have to justify by computing fixed overheads expenditure variance and fixed overhead volume variance. So subdivision of fixed overhead volume variance further can be computed by calculating the fixed overhead capacity variance, fixed overhead efficiency variance and calendar variance. Now the justification of fixed overhead volume variance I'll be telling you in the next lecture. In today's lecture I tried to make you understand about the formulas which are being used in computing the overhead cost variance, fixed overhead cost variance and variable overhead cost variance. So I hope, my dear students, you must have understood the topic of overhead variance, which I have tried to explain you today. In the next lecture of mine, I'll come with the numerical problems to apply these formula which we have discussed today. I hope you must have understood and enjoyed the today's lecture of mine. Thank you so much.